My background is important for you to know, for you to understand which angle do I come from. I'm not your typical actuary. As my friend Raffaello mentioned, that I have worked in insurance companies, I have owned in insurance companies. He mentioned a life insurance company in London. Actually, although it's a licensed insurance company, but it's not a life, it's a disability insurance company. Also in Russia, I had an insurance company. I had many insurance companies that I started, packaged and sold and made money. And closest to my heart is my foundation. And it was created because I believe there is shortage in knowledge in actuarial science in our part of the world. It was interesting. It was created after the Russians, after the default of the Soviet Union, they wanted to know about actuarial science. And they didn't want to go to the Americans or the Germans or the French or the British. They came to me because they were arrogant. They are Russian, they are Soviets. I didn't know any better. I thought I'm so great. They came to me to understand. But they came to me only because they didn't want to go somewhere else. But it was an education process for me because I was talking to brilliant mathematicians. University of Novosibirsk in Siberia is one of the leading universities in the world in mathematics. So that was a start of my educational career of teaching actuarial science. After a few years, I realized that they have asked to learn, and I responded. However, the countries where I'm making money, they are not asking to learn, and I'm not telling them they should learn. So I felt the obligation, I should knock at their door education-wise and tell them about actuarial science. Actuaries before me, which were like 20, 30 years older than me, they have monopolized the science. And they have given the idea to clients that this is like rocket science. Take it or leave it. This is the results. This is the report. And they never simplify the work. Where I believe actuarial science is like any other science. Sorry, there is none of you, I think, more brilliant than a neurosurgeon. I mean, I think a neurosurgeon has to make a decision split of a second when he's doing surgery. Ourselves, we can consult, we can ask our friends, we can take our time to take a decision. We can Google. So this is where my career, I want to call it as career, but it was really a passion to start into the education field. The only time you become valuable in education is when you are a practitioner. Some of the brilliant academics, which I know many of them, they are in la la land, completely out of reach, out of touch in reality. Some of consultants are in la la land. Unless you really work with clients and understand the structure, you become a valuable consultant actually. About 15, 20 years ago, I started hiring economists on staff. And that was an excellent decision of mine to bring an economist to review an actuarial work. Start hiring doctors and lawyers on staff, and nurses on staff, because we are very much into healthcare. And from all these people, you understand really the world. I have politicians on staff, ex-ministers on staff. And this is whereby I think we can add value to each other. We can talk and tell you how we see things are. After I have read the presentation of our colleagues before I came today, I realized they will answer many of the things that they will expect me to talk about. So I'm going to skip all that. Although I have some slides that shows that we were going to talk about it. I'm really glad when they're talking about the assets and liabilities. Quantifying liabilities, I'm not saying it's easy, but it's not bad, especially I'm talking about pension liabilities, especially defined benefit, although many actuaries think this is really difficult. You put a couple assumptions and you can calculate defined benefit plans. Assets has been overlooked. And I'm going to concentrate very much into the Social Security asset side. And I don't know anybody except one Social Security organization. I don't know all the Social Security organizations in the world, but I know one that is fully funded. Strange to think a national scheme that is 90% funded. Many organizations are 20%, 30%, 40% funded, and many of them don't have a funding policy. So they don't really have an objective to maintain that level of funding. I have asked for a board because I'm going to draw one line and I'm going to talk to you about the message I'm going to talk about right now. So when we are talking about assets, it is correct. Talking about the value of the asset, the discounting rate, and all this stuff. This is very important. If you can you put it here?
We asked which is 90%. Are you going to tell us the one that's 90% funded? Which one is 90%?
The Social Security of Oman.
Okay.
Yeah. Thank you. That's fine. But I don't see. I must see you. In case you are making wrong faces or something. Come closer. Yeah. So it's quite interesting to tell you how drastic things happen from one year to another. A few years ago, the Saudi Arabia country as a country decided to go into a spree of privatization. They privatized the airline, they privatized the railroad, they privatized the desalination plant. Within 2-3 years, they were privatizing so many organizations. Thank you. Thank you, Rafael.
I'm here for you.
This is all for you, so you don't move your seat. Thank you. Two things happened here. We think that there is movement of civil servants that under the Social Security scheme moved from the public scheme to the private scheme. You would think also some kind of liability issue in the pricing of the privatization. But we didn't realize something that took place seriously. In the privatization of these institutions, they were listed on the stock exchange. And they were mega organization, telecom, and stuff like this. What did the government say? Encourage the Social Security organization, invest in this newly private sector. And when you do an IPO or you go into privatization, usually the prices are low, and they went in bulk. I'm talking about $200 billion of assets went into the stock market, money from the public sector, from the pension fund of the public sector pension funds. 2-3 years down the line, the stock was going up, and the investment managers decided to start selling. What did the government say? The Ministry of Finance intervened. You cannot sell. Why you cannot sell? You are a big investor, you will crash the market. If you start selling the stock in the telecom, the prices will go down. So they were holding on an asset, on paper, has value, but they cannot sell. So when you are doing an actuarial valuation, how do you value that asset? This is something very interesting that we did not imagine it when we did one valuation, when we came to another valuation, and when we were building up an assumption of investment return. I'm going to draw a line here, and then we can talk about it. Security scheme, they know really about 3 important dates that when you do a scheme, you calculate liability or you make a presentation to stakeholders. The date where the contribution rate equal the benefits. The date when the contribution rate and investment income equal the benefit and expenses. And the third date when the fund is depleted. We came and started saying another date is very, very important. This date is very important because as long as there is a fund building up, all assets in this area you can evaluate very easily. However, after this date, the real estate you are earning, you would need to liquidate it because you have liabilities coming up. You cannot assume the value of the assets to drop like this. As normal asset you are tracked. When you are doing a valuation here, you cannot say, oh, this property has a value that I'm going to sell it. The minute you start shedding your assets, almost sometimes you think like this. So these things, unfortunately, government don't realize. And we get involved very much in valuation of the assets. I can list for you over 10 countries that we work in where government insists. Initially, it used to recommend. Now it insists Social Security to buy government bonds. They used to have investment guidelines and used to say 20% real estate, 30% this, and so up to 40% in government bonds. In Tanzania, the government, the central bank said, you can go up to 80% in government bonds. And they want to put another condition. You can, if you want to invest other than government bonds, you have to invest in investment instrument that can give you a return higher than the government bonds. But when the country is in debt and they are issuing government bonds, the investment return on the bonds are very, very high. So it's very difficult to find other instruments that beat the government bonds. In Lebanon, I don't know if any of you, probably most of you don't follow the news about Lebanon. In 2019, there was a major economic crisis in Lebanon. The Lebanese currency was 1,500 to a dollar. 1,500 liras, units to a dollar. Today, it's 89,500 to a dollar. This is after it stabilized in the past 2 years. It reached 130,000 Lebanese lira to a dollar. The money in the bank, and where the Social Security had 100% of their assets in the central bank, people were getting their pension, only 17% of their pension. So occupational schemes and Social Security schemes are very, very different. Why? Because in occupational scheme, funding is an issue. You have to be funded properly because employers have liability. In public schemes, what you are going to sue the government? What are you going to do? They can rewrite the books. They can reform the system by increasing the retirement age. You cannot do anything. I mean, in France, they went on the street, but what else? Nothing else. In private pension plans, that relationship is contractual relationship and protected by the government, by the regulator, by the laws. Social Security is really depending very much on us. We have, as actuaries of Social Security, a huge responsibility to deal with politicians and to tell them where they are heading. When I made a remark earlier that I said you lose a client. Yes, we lose a client because we have to be bold. We have to tell them, cannot be done. You are promising something cannot be done. You are imposing something cannot be enforced. Has major financial consequences. In Bahrain, they had, by the way, any figures or examples I give are public, so otherwise I wouldn't mention it. So you can quote me, I have no problem with that. In Bahrain, they had several $1 billion worth of assets. I stood up in front of the board of directors and I told them, you are actuarially bankrupt. And I looked at the young members of the board and I told them, when you retire, you are going to take that window. When you retire, you are going to take a door. You have no money. You have only real estate. You have no money. You have real estate. And then I gave them another example. I told them, take all these billions, give them to Prince Walid bin Talal, one of the most famous investors in the Arab world. Give him all these billions and tell them, assume our liability. He will tell you, go to hell. The promises of your liability is by far more than the assets you have. So the volume of the asset does not mean you are okay, you are not okay. I'll give you a small other example about countries that their assets valuation is very, very important to calculate. There's a lot of mismatch in assets. Right now, in Africa, they are so happy, they want to establish a major infrastructure fund, major social security infrastructure fund, pan-African. And I don't know if anybody here is from Africa. Currencies are not traded in Africa except in the same currency, in the same country. So you fly from Tanzania to Kenya, you take up some shillings out of your pocket and you say, I want to pay the tax. I say, what is this? They wanted to have a pan-African infrastructure fund. So we have issues here when we are talking about the assets. So I would like to move a little bit and talk about standards. I think only once earlier today we mentioned the word IS-19. I think the Americans have a gap parallel to the IS-19, something like this. Unfortunately, in every country we do IS-19 work, they only look at the liability of the end of service indemnity, whether 1 month's salary of the last several years, and so on and so forth. They don't look at liabilities associated with promises benefit. And Rafael knows that the most thing I talk about lately for the past 10 odd years is healthcare after retirement. There are employers until today in the third world so easy to promise their employees healthcare after retirement, and they don't put it on the books. I want to tell you something about healthcare, how serious it is, before even retirement. An American multinational organization in Belgium, but it's an American firm, had staff, multinationals from all over. One of their staff is a Lebanese. That guy is critically ill. He wanted to go back home. They transferred him to the Lebanese branch of that multinational. Because they transferred him, he was outside anymore from the local insurance company in Belgium. He came to the branch in Lebanon. The insurance company in Lebanon wouldn't insure him because he was dying any month. The auditors, an American auditor, said, you have to put the liability on the books. If the insurance company, you have transferred him. This is an obligation of the employer. So they appointed us to calculate the morbidity. What is the life expectancy of this guy? What is the healthcare cost And then I'm talking about somebody pre-retirement. And this is the sophistication of healthcare. And try to calculate that and they have to put it on the books, that liability. So these are issues that I would like to share with you. Now, I don't know if Tonia or somebody earlier said, or you asked, if somebody is $1. No, you asked the question. And I said yes. Because technically speaking, being $1 less or being $1 million less is less, accounting-wise. Accountants usually they go by the figures, by the decimal. Here I can tell you a small joke, and this is why he invited me for the last session, about this guy. Before he dies, he wanted to write his will. And he said, when I die, I want 1/2 of my will, my assets, what do you call it in English? When I die, my inheritance, whatever is, is behind me, what I leave behind, whatever, I'm trying to translate from Arabic, will go to my youngest son. And 1/3 is to my middle son, and 1/6 to my eldest son. He looked at the ages of his children, and he thought he wanted to be fair with his children based on what's their future liabilities they'd be. When he died, he had 11 camels to his name. So they brought a lawyer to execute the will, and the lawyer said, wait a minute, I cannot execute this will. I barely know how to add and subtract. You want me to divide? I don't know how to divide 11 into half. Go get an accountant. The accountant said, oh, it's very simple. Half 11 camels is 5.5. He wanted to continue the remaining of the division. They told him, oh, stop. What do you mean 5.5 camels? We cannot cut a camel in half. He said, I'm an accountant. I go precisely. If you want to be more creative, get an actuary. So they got an actuary. I think Tanaya have heard this story before. Get an actuary. The actuary came in and said, oh, that's easy. Fetch me a camel from the neighbors. Now we have 12 camels. Half 12 is what? 6. So, Mr. Young boy, you get 6 camels. 1/3 of the camel is what? 4. Of the 12, 4. You get 4. So now he have already given 5, given 4. And then 1/6 of the 12 is what? 2. They gave 2. So the 5, the 6, the 4, and the 2, that's 11. We still have 1 camel, return it to the neighbors. So we actuaries should be creative. And this is what differentiates us from others. I believe deficits can always be changed. In public schemes, it's much easier because, first of all, governments, they print money. They will cause inflation, but they print money. Governments can impose reform, increase contributions, reduce accrual rates, change the computation of the last pension salary instead of based on the last salary, but rather on the last 5 years or career average, whatever. There are many reforms they can do where actually occupation scheme, they cannot do that. Where do actuaries make mistake? And this is what I said, we are very proud to have lawyers. In my opinion, all our actuarial work is very legal. Every insurance contract, every pension, there is a legal back document that we try to price it. There's a promise, that's a legal document. In the Arab world, most Social Security in the Gulf, that's Saudi Arabia, Bahrain, Kuwait, Qatar, they have widow's pension. And if you know, maybe some of you know, there's multi-marriages. So a man can be married 2, 3, 4 wives by law. In the Social Security, in the rules of the Social Security, if the man dies when he's a pensioner and he has 4 wives, they get the pension equally, 25% each. If any of the wives dies, or not if, when any of the wife dies, they recompute the pension to 1/3 each. The youngest, the one that survived the most, she gets the 100% pension. I remember very well, about 20 odd years ago, 25 years ago, when we did the first actuarial valuation of one of the Social Security funds, they were wrong. The valuation was wrong. The assumptions, this is what we are talking about, importance of looking at assumptions, were taken by the actuary at that time. What is the average age between husband and wife? And let's assume it was 6 years. So when he calculated joint annuity calculations, the guy is going to die, let's say, at 71. His wife is 65. Her life expectancy is so much. And the funds were calculated accordingly. He didn't understand the culture of the Arab world. The culture is, when the man is age 25, his wife is 19. But when he married the second time, he's 35, his wife is 25. Now it's 10 years. When he marries the second time when he is 40, the third wife is most likely also 25 or 30. When he is 50, most likely his fourth wife is what? Also 25 or 30. So, but the regulation says you pay the widow's pension the same at the end. So what is the difference between man and husband and wife? It's 20 years, the difference between the last wife and the man, because they are going to pay a pension for the widow for that life. He died at 71, his wife is 50, or his last wife is 50. These are non-mathematical. And no pension fund during the active years of the beneficiaries maintain on data the changes of the marital status and the ages of the wives. So a person will not be able to capture that. He may be able to capture at employment when somebody joined the scheme. At that time, he was married. At that time, his wife was younger by him by 6 years. But this is when he joined the scheme at age 30. He was married maybe when he was 25. They know that data, but they don't. That data is not updated throughout. That is only discovered at the time of death. These are things which cultural knowledge is important. And this is where we bring to attention to the regulator that if the people are not nice or dishonest, a person at age 60, you can go marry an 18 years old, legally speaking, and continue to be working for 2, 3, 4 years, go to retirement, and that 18 years old will have a pension for 50, 60 years. They changed the law. That marriages have to be done at least 20 years before retirement to benefit. So these have to be brought up to the attention of the decision maker, the policy maker, is by technicians. We know the implication of this cultural habit. Another thing we have to bear in mind, any kind of deficit, if we are able to put our finger on, it takes minimum 5 to 10 years to introduce a reform. So any actual evaluation, don't think that, recommendation, even if they go by the recommendation, it has to go to the parliament. It first of all has to go to the cabinet. Cabinet have to discuss it, consult it, go to the parliament, enact it, and so on. So by that time, you have done another evaluation, and you have done different results. So you have to foresee your results 10 years ago. What will the result be? So you start the reform not based on today's results, but the results that you envision is going to be 10 years from now. Never ever you can try to look at the deficit. What is the deficit today? What is the deficit in 10 years from today? And start putting your recommendation to correct the deficit now, because by the time the correction is in place, that is the deficit that you are going to talk about. Otherwise, you are going to be talking about continuous reforms throughout the game. Also, when we look at schemes in social protection, it's a different ball game when you are talking about social security scheme. In my opinion, there are usually it's divided public service scheme and private service scheme. I introduce also the military schemes. Some countries, they manage the military with the public service schemes. Many countries, no. I remember very well in 2011 when there was a financial crisis, the government of Oman was late few days to transfer the pensions for the military to their accounts. Does anybody know what happened? By the third day, the military came by guns to the Ministry of Finance demanding their transfers. With the civil service, you are delayed 1 day, 1 month, they don't do much. So this is why military funds are fully funded. Military funds are fully funded. And I think in the US was taken a decision at one stage to really, the funding of the military is different than the funding of the civil service. I don't know the date, but it was taking place in the 70s, I believe. So the military funds are fully funded. The private funds in Africa and also in some of the Arab countries, Social Security for the private sector, are unfortunately, they are a multi-pillar systems. They were designed to be similar to what the civil servants have. I don't know how many people knows the history of Social Security. Social Security, at least in the developing countries, were created to buy loyalty. The colonial mentality, colonial countries, they came to Kenya or Tanzania, wherever, and some of them, they brought the Indians army with them, and they put their own civil servants with them, and they gave them a very generous package for pension, and they told them, you work for us, and we'll take care of you and your family for the rest of your life. Which is really a pillar 1, pillar 2 type, because they are one employer, it's a government. Over the years, trade unions and labor market start putting pressure on government. We want to be having similar benefit like the civil service. Because there were no actuaries, all private social security systems in Africa is copy confirmed of the benefits of the civil service, without realizing that they have different profile of population. In the private sector, you have industry like the banking industry, hotel industry, different industry, and every industry has different economics. And every employer has different interests. Having the same scheme with portability of benefits, what's happening? A person works for a bank A for 6-7 years. He got a better job with a bank B. Not only he leaves and he gets his benefit with it, he becomes a competitor for the first bank. And they are paying Pillar 1, Pillar 2. Now we are working to introduce a split between Pillar 1, Pillar 2. Pillar 1 to be portable, Pillar 2 not to be portable. And then becomes really a defined contribution. The contribution during the years with that employer, you have acquired the rights for that. You move to another employer, you don't take that contribution with you. They refund the money and so on. So these things actually have to do to keep the private sector Social Security scheme viable. Private sector right now in Social Security scheme in most countries are in deficit. And I mentioned earlier, they are barely 20-30% funded. Barely 20-30% funded.
Actually, in my PhD research, I studied peer-to-peer insurance. And the most prominent researchers in peer-to-peer insurance, they actually like to show an example of the takaful insurance of the Arabic. I would like to ask you, to hear you, what do you think about takaful, Waj Hazan, and how can this structure of Arabic could be applied to a framework of deficit resolution and risk sharing among peers, among people who want to have some kind of insurance? I want to hear you about takaful.
Although I'm going to answer you about takaful, but I would like to tell you I'm Catholic. So it's not like my answer, not because my name is Ibrahim. I'm not Muslim, I'm Catholic. But yes, we do work with takaful. And as a matter of fact, there are social security organizations right now moving in takaful, like in Sudan and in Malaysia and so on and so forth. In takaful itself, the only thing that is prohibited by Islam is interest rate. Interest rate. Because the concept of interest rate, it is guaranteed income irrespective of the risk. In takaful, they say, you make money, we share the money, you lose money, we share the loss. But unfortunately, in my opinion, this is a crap. This is not really practiced correctly. Outside Malaysia, in Saudi Arabia, in many, many countries, the takaful companies are very commercial companies. Now they have 2-3 companies in Jordan. They just opened 2 companies in Tanzania. In Lebanon, we don't have takaful. In Saudi Arabia, they did not want to call them takaful. They wanted to call them cooperatives, which is like a mutual. So I don't like to bring religion into insurance. There are people, especially right now in Ethiopia, there's a big movement. And in the last event that I was speaking, I had a clash with the guy who is spearheading the takaful industry in Ethiopia. And he said, we are Muslim. I said, this is not correct of you to say that. Because if you have good products, Christian can buy it from you. Not because you go to what do you call it when you say somebody is not smart? Ignorant village Muslim guy and tell him, I'm going to sell you a takaful policy because this is religious, it's halal, it's not haram, it's, your products are not good. He better off buy a Christian product. I mean, a commercial product. It's not a Christian product, commercial product. So I'm against takaful as it stands. The way they use takaful to sell a product that is not sellable. I'm against interest rate. I think banks make a lot of money irrespective of the risk I'm taking. And that's a different story. But I don't like to work on the weaknesses of people to tell them this is as if this is from heaven. I can protect you. This is not right. There are many, many takaful companies that went insolvent because the operator of the takaful company makes the money. The operator makes the money. So this is my point. The question is right now whether Social Security that are Islamic Social Security, whether it should pay interest rate on their investment income. This is a very big debate whether they pay tax, sorry, not interest rate. They pay tax on the investment income because they say this is the takaful product, we made the money in a proper way, we shouldn't pay tax on it. So this is a lot of issue regarding Social Security and takaful.
Thank you.
Any other question?
Hi, Ryan. How are you?
Hi, Fabio.
I've actually come across many cases which are all of them awkward, one way or another. And now that you've actually talked about interest rates, the most awkward one that I actually found myself with was a pension plan, private pension plan, under a DB structure, which every year, at the end of the year, the actual interest earned over such year was distributed as a lump sum to all the participants. So it would never ever work in favor of their reserves. It was something like only the past contributions as they were, without any interest on top of that were actually going to be facing the facts of future endowments due to debts, morbidity, disability, and so forth. So that is a very interesting way to handle something which, at the end, with just one death, I remember that happened about 5 months after the last valuation made to the plan. It actually nearly broke because one person died and the amount for death was nearly as much as the fund itself. Given that no incentives have been introduced to the plan for all the years that the plan had already.
Governance is the issue. Proper governance of funds are very, very important. I think in Europe, I don't know about the States, they are very, very strict about governance of pension funds and of advisors, and whether the advisors is involved in investment advice or only purely actuary on the liability side. Administering pension fund is a very big issue. The latest study we did in Africa, by law, most of the pension funds in Africa, when they were established, the law says administration costs cannot exceed 10% of the income. Who wrote the law did not define what is an income. You and I would know that we think he meant contributions. That's a contribution income. Many funds, that's an income. They said that also investment income is an income. So they start putting 10% administration expenses on the total income. They get away with it. Now they have already an acquired mechanism of administration, very heavy administration cost. And all of a sudden, this assets mountain starts reducing. And that asset mountain starts reducing, and the investment income subsequently starts reducing. So automatically, the administration costs start exceeding the total investment income, the total 10% of the investment income. And they didn't know how to manage to reduce the expenses. Another, I'm talking about issue of governance. Another issue, all of these funds, they put their budgets 2-3 months before the end of the year. When they write their budget, they write off our budget is to have, let's say, $1 million of investment income. they build the expenses for that year, for the future, under the 10% of that investment income. But as the year go by, they do not collect contribution in $1 million. But they have spent more than the 10%, or the 10% of the $1 million. They have spent the $90,000. But they have collected only $800,000. So there is a lot of receivables, but these receivables by employers, they run out of business, they don't want to pay contribution anymore. So governance is very, very important. And there is no proper mechanism in place. We come to them and we say, you cannot anymore forecast your budget on expectation of income. So this is where we are the ones that pick up on things like this, because we understand many accounts of Social Security, the income and the expenses and the benefits, the difference, they call it a surplus. Can you imagine? They call it a surplus. What does the politician see? They see an account, surplus. Surplus is a profit. There is no entry of reserve associated with that new liabilities in that year. There is no entry in the accounts. So we had to have discussion with the Attorney General to change the account of Social Security of that country. Because the eyes of the politician, give more benefits. You have surplus. Why don't you give more benefits? So they increase the accrual rate or reduce the computation period. Let it be on the last salary. Yesterday I was in one of the sessions, I made a big example of the government took a decision to increase 3 times the minimum wage. 3 times the minimum wage. They bankrupted the Social Security. But they thought, we are only talking about the salary. We are not talking about the pension. So wait a minute. If you are talking about the salary, the people, they are about to go into pension, to become pensioner, they are going to benefit from that new formula of 3 times minimum wage. But they have contributed for 10, 15 years on low salary. Nobody knows. We have lost business when we speak out. This is what I mentioned. Sometimes you do have to speak out because you have, I think, professional obligation to educate. Many actuaries don't go on TV, they don't give press releases. I'm constantly with cabinets, with TV and everything, talking about issues like this for the people to understand that they're not making money. This money are for future liabilities.
I don't have actually any questions, but I'd like to make some comments that may seem interesting to you or to other colleagues from outside Brazil. First, about what you say that some pension schemes heavily invest in government bonds. This is the case here in Brazil. We have several pension schemes that invest to 80-90% of their assets on government bonds. But there is a reasonable, we'll talk about that in a moment, a reasonable explanation for that is that the Brazilian government issues inflation-linked bonds. So pension schemes, they have inflation
Index pension.
benefits that they can hedge it with inflation-linked government bonds. And the second comment is for health liabilities. So we also have this in Brazil because there is a law that's called, there is law number 96, because it's from 1998, so it's not something new. That whenever an employee participates in the pays partially of the health insurance premium, if they do that for 10 years in a row, they can stay in the pensions plan, so in the health insurance for life. So there's a quite huge obligation sometimes. And consulting firms and auditing firms, they're very aware of that. So
First of all, in my humble opinion, if the country imposes on pension funds to have investment in government bonds, anything over 50%, they should guarantee the fund. They don't impose the...
No, they don't impose.
Okay, if they don't impose, I will fire the investment managers. That is high risk to accumulate all your assets in one. No matter how stable the Brazilian government is, no matter how stable, this does not make sense. Does not make sense. They should, I think the investment manager of that pension fund is finding the way easy. I'm putting my bonds in the government, is indexed to inflation, is matching my future liability. That's it. That's the easy way out. Pension funds should be, I think, should be vibrant. They should invest here, there, and everywhere, and they should be responsible in their investment. To put 70-80% with one institution, they are putting all their eggs in one basket.
That's true, but what they say is that if our country breaks, everything will break before it, because the company, the country, can print money and can, how can I say, run over its debts. This is what I heard about the asset managers, but I don't know. I understand your point.
Lebanon was known with two names. Some people say Lebanon is the Swiss of the Middle East, Switzerland of the Middle East, and some people say Beirut was the Paris of the Middle East. In both cases, the decisions of these examples is because of the strong financial sector of Lebanon. We were the first country outside the United States to print traveler checks in Lebanese currency. Traveler checks in Lebanese currency was accepted anywhere in the world. Strong like a dollar. I don't believe in governance. I don't believe in government. I believe if these people in occupation pension scheme, they want the government security, let them go work for the government. And let the pension fund do whatever they work for the government. We have to also differentiate something I did not mention. There are two types of Social Security and there are two types of pension funds. Contributory and non-contributory. Contributory pension funds, the employee have a say. They must have a say. They should be on the board of directors or trustees of the pension fund. This is their money. Even the money paid by the employer is their money, is a promised contribution by the employer for them. That's not easy. This money, fiduciary you call it, this is something sacred in my opinion. Somebody one day retired to have that money. Unless the government guarantees the fund. Many Social Security in the world, the government is taking out that guarantee, the underlying guarantee. So this is my opinion, but I don't have to be right. But I don't like to put my money with the government.
Well, one thing that has just happened around the corner was actually COVID-19, and there many lessons had to be learned from, in particular in terms of Social Security and pension systems valuations, and also how to handle the money. We found out that, for example, we saw how the Chilean model had a problem because the government actually agreed that in order to be able to allow some help over to retirees and to people who were actually being active, then the pension system had to provide them with some money up front, leaving that forgetting that, hey, hold it. If you're talking about the defined contribution program, that money actually has something which you have it in future. So if you want to keep some sort of pension, then you have to be very careful on how to handle such an amount of contributions. Otherwise, everything's going to go down slide in a very short time. The same thing has happened with other parts of the country where such practice was also being applied, like in Europe, where the UK, Spain actually provided such kind of help to people, which is not help whatsoever, because that's their savings for their retirement. That's my opinion. Thank you.
I tell you a small personal story. In 1979, I had just returned to Lebanon after 1 year after being abroad studying. My father does not write or read. My father drives a bulldozer. He saved all the money until he sent me to America to study. As a matter of fact, I studied only, just to correct your knowledge, Raffaello, in America. When I came back, I started working good job as an actuarial intern in a company in Lebanon. And my father was getting old, so I convinced him to retire. I told him, I'll take care of you. I'm your only son. You educated me. I'm going to take care of you. So he accepted my proposition to him, and he took his retirement. Was 300,000 Lebanese pounds. At that time, the Lebanese pound was 3 to $1, not 1,500. If you remember before, I told you the story about the 1,500 and now 889,000. It was 3 to $1. My father took the $300,000, 300,000 Lebanese pound, that's $100,000. He felt great. That is his lump sum retirement, end of service indemnity retirement. Me, as dumb, educated person, with good intention, but good intention is not enough, I went and bought silver with the money. Within 6-7 months, the silver started going down. I start buying more to lower the average of my initial investment, and I finished all the money of my dad. And during all this time, 6-7 months, I didn't tell him anything. He thought he had dollars because he converted his 300,000 to $1. It took me about 5 years to slowly work to make $100,000 in savings for my dad, because he would have a heart attack. During these 2-3 years, my mom was going crazy of my dad being retired, and she kept telling, get him out of the house. He should go back to work, but not because anything, because he was taking her privacy. She was a lady of the house. All of a sudden, there's somebody in the house, I was happy. He was working at that time. I was trying to reinvent his money. That tells you that really investments of retirement is very sacred. You don't mess around with it. Who am I to understand currencies and bullion, silver and gold and all stuff? I think people that overlook investments, whether defined contribution plans or defined benefit plans, have a big responsibility. And they should get proper investment managers to do so. In my initial introduction of my presentation today, I said valuation of liability is easy. The assets are difficult. Raphael allowed me that by the end of my presentation today to talk a little bit something that's close to my hand, which close to my heart, which is healthcare after retirement. Calculation of liability, in my opinion, of the pension is easy. calculation of healthcare, liability of healthcare after retirement is a different animal. And this is where I hope the profession really take part into that action. And there are two healthcare after retirement. The way there are two types of defined benefit scheme, occupation schemes and social security scheme. In healthcare, there is private healthcare, occupational healthcare, and there is national healthcare. Most national healthcare that provide healthcare after retirement, technically speaking, are bankrupt. There are countries that already reached the equilibrium, they know their cost. It's mounting, but they know their cost. Countries that have a very young population, the healthcare cost of the retirees is negligible, so they are offering benefits, not realizing what they are heading to at the point that they will not be able to provide that cost. So I'd like to leave it at this point. I did make a presentation on the paper we are submitting to the IMF about introduction of implicit healthcare, implicit debt. There is right now on the books of IMF that they are pushing countries to have implicit pension debt. Some countries are putting into their national accounts. Some countries are refusing to recognize the implicit pension debt. And no country that we know of have on their account implicit health debt. We are quantifying right now on 90 countries around the globe, looking at the healthcare after retirement, what is the projected liability of that, and quantifying that. And we are submitting a paper. I have on staff now a full PhD, actually. Her dedicated her almost a year right now, been working on this project. She has with her two actuarial, one is a PhD candidate and one is just qualified actually, trying to work on this paper. I did ask during the meeting if anybody would like to volunteer to work with us or to peer review the document. We will be more than happy to have somebody with us on this study. I just only for the purpose of a teaser, I showed in the presentation 6 countries or 7 countries, but we have 60 countries and we have all the data we need to finalize our study.
Professor Ibrahim, I'm seeing your slide, and that's the resolution and strategic framework. I would like to hear you about the last one, risk sharing and governance tools. How can this strategy with risk sharing and governance tools can help handle deficits?
Trying to go back, sorry. I don't know if anybody is working. Anybody in the room works on Social Security or only occupation schemes? Anybody works on Social Security? Social Security, we have a very nice time horizon, and we have a lot of data. It's by far, I think it has its complexity, but it is much easier as well. When you have to talk in Social Security, we are talking about several million contributors. You are talking about beneficiaries that are in tens of thousands, hundreds of thousands. You are talking about funds of several $1 billion. There is tools right now that are talking about how you can optimize your investment return. I'm not an ALM expert, but there are, I think you touched issue on the profiling of the assets and the liability, looking at the liquidity of the, not liquidity, the short-term liability and the liquidity of the assets. There are tools that generate thousands of scenarios and then look at the optimum scenario and recommendation. I'm far away from it. I mean, you can see graphs, and I think when they run the report, they are talking about tens of thousands of scenarios and so like this. And I remember once our office, they say they waited on the computer overnight to finish the runs to generate the report. There are tools to look at. As long as the government allows you to do a balanced investment portfolio, you should have these risk tools to look at it. When governments direct you only to one assets, I mean, like our colleagues from Brazil said, oh, the government give us the solution, give us an asset that mimics the promise that we have. We have index pension. They are giving an asset that provide index returns, inflation index. We don't really worry about it. But at that time, the government is becoming a partner in your decision. If one thing is still missing, if they sign under the bottom line, that also they guarantee the fund. You know, they guarantee the fund. So I don't know if that is answers your question.
For sure.
Yeah. I have other slides, but I think I jumped from one slide to another. Most reforms of Social Security so far is changing the benefit formulas, or changing the retirement age, or introducing what they call penalties for early retirement. Before, people retiring at 45 or 55, there were no actuarially calculated reduction in their benefits. So these are the issues that Social Security funds have by far more than occupation scheme. They can work on the benefits. They answer the deficit by working on the benefits, not working on anything else. In occupation schemes, it's very difficult to work on the benefits. The only experience I know of occupation scheme, they close the fund and they start a new fund with different benefits. It's known on British Airways, many schemes that we know. They close the funds for new entrants, and they start new funds with different benefits for the new entrants. Earlier today, somebody asked about mortality tables and what kind of adjustments do they do, and I said, yes, we do enhanced investment mortality tables when you do a projection of 75 years. Of course, the people that are in the scheme right now and retiring in the next 5, 10, 15 years, we apply a certain mortality table, but the ones that are retiring after 30, 40 years, we will apply an enhanced mortality table. In all cases, in Africa, there is no African Social Security table. I don't know who was beside me today, Mika from Finland, who I approached 4 years ago because we offered as Muhanna Foundation to finance the creation of a mortality table for Social Security of Africa. And they voted on it. So we sent out the data requirement, and that is the Council of all the Social Security of East Africa. And they sent me a big thank you, and they said yes, and nothing happened. And in the meantime, initially, the first few months of the decision, I have recruited Mika from mortality people that I know that are interested in structuring and in the structure of mortality table, and decided what kind of data we have to get and how long it will take us to provide the table. And then everything died, and that is an offer. I mean, it's not like we are getting any money on it. It died. We didn't follow it up. It died. Just 2 days ago, and I was showing Mika the letter at lunch. I said, guess what? They just voted in the council that and they called me. I mean, they sent a letter after they called me. They said, "Is your offer still valid? Are you still willing to finance the construction of a mortality table for Social Security in Africa?" I said, "Yes." So they sent me a letter confirming that the council have voted that they want to cooperate to give us the data. I told Mika, "Are you still willing to assess?" He said, "Yes." So if anybody is interested in mortality and would like to help with us, I will appreciate it as well. And that is, I think, 9 countries that we will be getting that data from.
We have talked about contribution, defined benefit and defined contribution schemes. I was thinking also, in what way pay-go systems and fully funded systems can affect the results of a defined benefit or a defined contribution system. And pay-go systems are not subject to great problems from the volatility of interest rates of the return of investment, but they are more subject to demographic changes. So in both cases, what can be the best mix, for example, for a theoretical perfect system?
In 2004, there was an intention to reform the end of service. In Lebanon, there is two social security systems. One for the public service, which is salary-based pension, the defined benefit. And for the private sector, it was end of service indemnity. It's a lump sum. So there was a push to introduce a pension system. But at that time, they wanted to introduce a hybrid system between defined benefit and defined contribution. What we and the World Bank accepted at that time, to create a pension, only the minimum salary is guaranteed. Above the minimum salary is almost like a defined contribution. In countries that don't have technical people or administration of pension, defined contribution is much easier. I mean, the Chile model that the World Bank was pushing for many, many years. After the financial crisis in 2008, the World Bank, they shut their mouth. They stopped pushing. They carried the Chile model on most East European countries. They sold the concept of defined contribution. And this is when somebody, Octavio mentioned, what about if the investment are gone? And then people lose their money. Defined benefit is still the answer, really. So the hybrid would say, okay, it's a defined contribution with a minimum pension output. There was another scenario whereby they wanted to have a defined contribution with a guaranteed investment return. And I remember very well, I reached out to several actuaries and said, how do you price a guaranteed interest rate? You know, certainly we didn't have anybody in our office knows how to price a guarantee. Even a 2% guarantee, we didn't know how to build it into the contribution rate to be able to guarantee investment return. I don't know if you have worked on something that you have done. I wish I reached out to you at that time. Yeah, I didn't know that. So, and we told them we don't know. So there are ways that there are issues that could be done, but you need experts to. And I am very proud to say that some of our people, they challenge me when we are not comfortable in an advice to stand away and say we don't know, look somewhere else.
So I would like to thank you very much, Sir Ibrahim Muhanna, for being here and for speaking for 1.5 hours with many, many insightful considerations. I would like to thank the audience also for participating so actively to the discussion. And so I believe that we can consider this workshop concluded, even this second session. So thank you again, everybody, to everybody, and I will see you around. I don't know if someone is still remaining here for the next day as a week. Okay, so we will have the chance to meet again. For the others, it has been a pleasure to see you, and see you next time at an IAA event. Bye-bye.
If you notice, since you can download the slide presentation, it has more slides than I talked about. If anybody has any question about a particular slide or something, feel free to send me an email. I'll be more than happy to reply.